everybody. Oh, there we are. How's everybody doing today? It's nice to see you. It's good to get started here first thing in the morning. And I always look forward to my classes. Summertime, we're on a shortened schedule, so we only meet a couple times a week, but that's okay. It gives us a little more concentration on specific subject matters. Now, today, if you'll notice out on the little marquee for the movie theater, the thumbnail out there, I said we were going to do the bull call spread with a naked leg. And I actually put that out last Thursday, which was our last class. And last Thursday, I said we're going to do bull call spread with a naked leg. And we got so distracted on everything we had to do. And then I had to go. I had a meeting I had to be to. I didn't have time to go into the bull call spread with a naked leg. So all we did is talk about our UBI portfolio last time, and we didn't get into the naked leg. So this time we're going to reverse it. We're going to make sure we get the naked legs put on there. We're going to make sure we get the options on there. And then at the end, I'm going to update my UBI portfolio because last night I got a whole bunch of dividends come through. And so I'm anxious and excited to update my spreadsheet to see how things are turning out. So yeah, we got about $10,000 in dividends last night. So I'm going to add those to my spreadsheet. And I'm going to do my real money spreadsheet for you. Usually I do the demo count spreadsheet, but we're going to do the real money account spreadsheet today and put in my real money dividends that came in. So how does that sound? But I want to do the bull call spread with a naked leg first, reverse the order from last time when we did the UBI first, and then we didn't have time to do naked legs. So we're going to go through the portfolio first, put on some bull call spreads with naked legs, and then we'll go and update the spreadsheet. How's that sound for what we're going to do today? All right, so stick around for that, and you can see my real money account, and you can see my real money updating of my spreadsheet, so you can see where my dividends came in and how much we got. It was small. I was a little disappointed. Well, you can't be disappointed because it's a lot of money. But last month was just a lot of money. I mean, last month we had a really good dividends. So you're going to see this month so far not quite as good. So, but that's okay. It goes up and down. Markets move in waves. They go up, they go down. We make money, we make more money sometimes, we make less money sometimes, and that's all right. It all works out in the wash at the end. Okay, so let's go through and start at the top of the list. We're just going to go down through the YouTube class portfolio here, as you can see. And I'm going to make the screen a little bigger so we can see it a little bit better. So there we go. And what do I want to do now is I want to just go through. We'll start with AMD, and we're doing pretty well on AMD. All right, we got in right here on AMD, and we were doing that just as that A1 was coming in. And so we caught that nice run. And then we noticed that it was coming into a B1. So we didn't liquidate, take our profits. We were anticipating a continuation of the B1. We got the B2, and it's up here. And it'll probably be peaking out up in here if we just measure. Let's zoom in, zoom. Uh-oh. Okay, are we back? I don't know. Are we back? Can somebody give me a thumbs up and let me know we're back? It says we're back. Okay, I think we're back. I don't know. I'm going to go on as if we're back. Somebody's going to have to give me the little thumbs up and tell me in the comments I'm back. Oh, John's saying we're back. Okay, the StreamYard software crashed. I don't know if you guys saw that or not, but where did we get to? We got to AMD and we're zooming in, right? We're zooming in on the software and we're coming down here and I don't know why it crashed when I did that, but it had nothing to do with the software. It had to do with the StreamYard software. You know I have problems with that piece of shit software. Piece of shit software. I would get something else. Oh, it just was frozen for a few minutes? What could you see? Could you see like the computer screen and everything? It just what happened? I don't know on your end what happened. My end, the whole thing just went black and everything. I had to completely restart my computer and the whole works. So it crashed good. All right, here we go. We're back at the get back into the swing of things here. The AMD is coming in here, and let's get rid of some of these little things. Delete all the arrows, and we come in with the A1, A2. This one didn't have an A2. We just came straight into the B1 right in here. So the B1 is where the blue lights cross, right? So that's your B1. Now we have the lost my mojo, my train of thought here. Send to back. There we go. All right. So this is our spider web right in here. We're going to draw it into the spider web tool. And so this is the spider web. And so whenever I'm like a little bit, like I don't know where the A1 is, AB2, like that, it's because we have three different locations that you can put your B1. So you can put your B1 right here on the blue light, the crossing of the mathematical trend line, or you can put it down here where it's down in the valley, a little bit break beforehand, or you can even put it up here where it breaks above the previous high. So there's three locations that we can use as our breaking for the B1. It goes off this high, which is of course the Fibonacci bow tie. So if we draw the Fibonacci bow tie in there, the Fibonacci bow tie comes down here to the low point, right? We'll just use this one because it's further out. And then we go up here and then we anticipate a pullback to the previous high like that. That's the Fibonacci bow tie. All right. So when you get a Fibonacci bow tie or you anticipate a Fibonacci bow tie in here, the Fibonacci bow tie, generally what we're looking for is we're looking for the market to be a same distance from here to here as it is from here to here. All right. So that's kind of how that bow tie works. But we've got down here, it's like, where do I put my B1, Lan? Where do I put my B1? Well, we always put it on the blue light, but that's not necessarily where the B1 starts. You have a B1 that actually comes down in here, which is the little spider web thing in here, where you have a natural breaking of the trend line down in there. So that can be your B1 as well. The blue light can be your B1, or you can really delay the B1 until it breaks above the previous high. I don't like to do that. I like to either put it on the blue light itself or down in the valley before the blue light. All right. But that you're going to have to, if you're going to take it down in there, you have to estimate that it's going to be a B1. It might continue to fall and you'd say that was your B1 and then it wouldn't be. So that's a little bit of, exactness. If you want exactness, it's got to be on the blue light because that's the only time you ever actually truly get a confirmation of the B1, because you could call this B1 down in here and try and call it early, but the first green candle to make a new high after that drop down in there would be your B1, but you're getting in early. And we talk about this in the manual, right? I would show you the manual, but when the software crashed, it crashed too. I don't know if I have it. Let's see. Where do you get the manual? Everybody's like, where do you get the manual? And did you write any of this down? I did write it down. Slides, there they are. So the manual is right here. There you go. All right. You can get the manual out on Amazon. All right. And the manual has all this stuff in there, has all these little counts, A1, B1, C1. It has the little spider web in there. We talk about the spider web. We talk about the Fibonacci bow ties. We talk about all this stuff. We talk about Fibonacci um, uh, retracements and how to count, measure, set up, trigger, and follow through. All right. And how to use the the indicators properly. Let's see. All right. So we are going to go back to the software. All right. So how do I get that off of there? There we go. This dumb software. All right, here we go. So this is the patterns that we're looking for. So where are you going to put a bull call spread with a naked leg? That's what it comes down to. We got to find the right timing. You don't just throw bull call spreads with a naked leg onto the screen just because, well, Lance said to put on bull call spreads with naked legs. You have to have the right timing. And so putting on bull call spreads with a naked leg is very important in the sense that just like any type of order that you put on, timing is everything. All right. Timing is where you decide where the right probabilities are that the market's going to move in your favor to have that bull call spread be profitable. So I like to put bull call spreads on. When I put them on, I like to put them on generally at a B2. All right. Or a A2. And the reason I like that is because it's got a pretty high probability that the market's going to go up a distance that we already know basically the distance because we have a previous leg to measure off of. All right. So if we use that previous leg to measure off of, we can measure that that's about the approximation of how high we would expect the next market to go. And so that's how high we can put our bull call spread. So let's talk about bull call spread just for a second. And I lost my slide, so you have to give me a second to pull it up again. All right. So thank you very much, StreamYard, for crashing on me. Not that one. I wanted to go through and show you this one right here. All right. That should work right there. Okay. So I'm going to get out of the way here. So I want to talk to you a little bit about, just give you a quick introduction to options, and then we're going to talk about bull call spread with a naked leg. Now, I know it's a little bit of an advanced strategy, but it doesn't have to be. It's not that complicated. Once you understand the concept of, A drives, B drives, C drives, B1, B2, B3, once you understand what those drives are, and most of you in my classes, you've been coming for a while. We got new people here, and we always got new people coming and watching, but it's one of these things you have to get immersed in. So you have to kind of just keep coming to class, and we'll just keep doing this stuff over and over. And then it makes more sense because we do it on active markets, and you can kind of apply this to your own portfolio as we move through price and time and as we move through the summertime. All right. And we want to put on bull call spreads right around I like to put them on in the B drive. That's for me the best place. But the B1s, B2s, I don't necessarily like to put them on B3s. You can, and there's an argument for putting them on B3s, and there's an argument for not putting them on B3s. But we're going to talk about that. All right. So what is an option? Option is the basics. Options are financial instruments that give the buyer the right but not the obligation to buy, which is a call option, or to sell, which is a put option, an underlying asset at a specified price, the strike price, or on or before a certain date, an expiration date. If you want to think about it in real estate terms, it's like earnest money. So earnest money, when you buy a house, you go up and you give them earnest money. All right. You're like, oh, that's a beautiful house. I want to buy it. But it's going to take you maybe 2 or 3 months to get all your paperwork in line. Right. So what do? You lock up the house and say that you can't sell it. I'm going to give you some earnest money, put some money down on the house. Therefore, you can't sell it. It's mine. I have locked in the price that we agreed to. We have an agreed upon price, and I'm going to give you the earnest money. And now I'm going to go do all my things that I need to do to lock in the price. Now, what happens if the price of the house suddenly falls for some reason while you have your earnest money? Well, earnest money gives you the right, but not the obligation to follow through with the purchase of the house, right? In 3 months, you might decide, oh, I don't want that house for one reason or another. Maybe you couldn't get the financing. Maybe the house fell in value. I don't know. There could be many reasons why you decide not to go through with the purchase of the house. Well, you don't lose anything but the premium you paid, right? You don't own the house. So if the house falls down in value significantly, you don't take that loss. The homeowner does. You just lose your earnest money for not going through with the deal. So let's say you put $2,000 down, the house is worth $400,000, and the value of the house while you have the earnest money goes down $100,000, one reason or another. You don't lose that $100,000. The homeowner does. You just lose the $3,000 because you're not going to go through with the purchase. All right. It's so an option is exactly the same thing. You're putting down earnest money on a stock and you're saying, I want to buy that stock. Now, the loss that you have is the premium you paid for the option, right? You could lose that premium, but you're not going to lose the value of the option. So if you put an option to go long on AMD, for example, and you pay $1,000 for an option and the market goes down and it loses $2,000, well, you don't lose the $2,000, you just lose the 1,000. The max amount you can lose is the premium or the earnest money, right? So think about options like earnest money. Now, they get a little bit more complicated than earnest money, but that's the basic structure, all right? There's only two types of options. There's calls and there's puts. So you can buy a call and you can sell a call. You can buy a put or you can sell a put. That's it. So don't try and make it more complicated than it really is. Now, you can do all kinds of combinations of buying and selling different options, buy a call, sell a put, buy a call, do whatever you want, and make combinations. And those are what we call strategies. All right. So that's where you get your bull call spread, your vertical spread, your naked legs, your all kinds of fun things that you've heard, all these different names, but really all they are is just a combination of buying a call or selling a call, buying a put or selling a put. That's it. All right. So don't make it more complicated than it is. Oftentimes people try to, throw out around these big words and, because it makes them sound fancy, maybe on a date or something. I don't know. But, I trade me some iron condors, and it's very impressive. Very, 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 very impressive. All it is an iron condor just means they bought a call and they sold a call. Oh, yeah, but I also bought a put, sold a put, so therefore it's an iron condor. We try to make ourselves sound really fancy in this industry. It's just really simple stuff. All right. Okay, so that said, we have a couple other things we need to take into consideration. One is the premium. The premium is the price we paid or received to enter into the options contract. All right, the premium. That's the earnest money, the amount of money you put down, right? If you put $2,000 down, that $2,000 is called the premium. So the strike price is the price in which you agree to buy or sell the underlying asset. Therefore, let's say you decide to buy the house for $250,000. Well, that's the strike price. The strike price is $250,000. Well, when you're trading stock, you can agree to buy the underlying stock at any price. You can say, well, it's currently trading at 136. Well, I'm willing to buy it if it hits 140. So the strike price could be 140. I mean, you could do that on a house if you wanted to. I mean, it wouldn't really make sense, right? But you could do it. You could go into a house and say, well, you're offering 200,000 or you're asking 200,000. Well, I'm willing to buy it if you'll sell it to me when it hits 250,000. All right. That's how you'll offer more. Or you could do it the other way around, right? You could say, well, if you'll drop it down to 150,000, I'll buy it. And that would be the option. And that would be the strike price. All right. In the stock market, we can have our strike prices at any level, not just at the current action price. So right now, see, AMD is at 136, 137. It's trading right here at 136. So you could actually buy an option to buy the underlying stock or buy the AMD at a different price. You could come down here and say, well, I'll buy it buy an option at 116. That'd be called in the money. All right. It's an in the money option if you're trying to offer less for it than what it's trading at. You're saying, well, I want to buy it at 116. Well, it's currently trading at 137. We'll give you that option, but it's going to be very expensive because it's already got a bunch of built-in profit in it, right? So if you buy them at 118 right here at this B2, Well, it's already at 137. So you're going to have to pay for, if you buy an option at that level, for all of that premium that's in there. That's why they're called in the money, and that's why they're very expensive. But that's the strike price. The strike price is just the price in which you're willing to buy the stock at. You can put it up higher too and say, well, it's trading at 137, I'll buy it at 146. But that means the market would have to go to 146 for you to be, in the money. All right, so the expiration date is how long you've got before the option expires. Well, that makes sense, right? So the expiration date, meaning that on your earnest money, then your earnest money is the amount of time that you've got to get all of your paperwork in place, right? So if you put up 3 months on earnest money on your house, you got 3 months, that's the expiration date. Pretty obvious, right? We have the same thing in options. So the intrinsic value versus time value. So you have two different types of value in an option. Let's come back over to the charts quick, and I will show you. So you have two different types of time value. Or value in an option. You have intrinsic value and you have extrinsic value. Now, those are big terms. Again, we're trying to, sound important at our dinner date. Intrinsic value just means the amount of money that the market has already made. All right, that's intrinsic value. So, again, back to our example where we're going to say, well, if we want to get in at the B1 and it's currently trading at 119. Or B1 was at 119, 120, but it's currently trading at 137. If you were to buy the 120 option, the intrinsic value would be the amount of money from where the 120 option is, 120 to 137, right? And let's say 140. So you'd have $20 of intrinsic value. All right, that's the in the money option. So we can come down here to the options chain, and you can see, and if some of you are like, this is just going way over my head, I just don't know what the hell you're talking about, Lan. Don't worry about it. Don't worry about it. You just have to get exposed to it for more time. You just have to keep coming and keep coming and keep coming and watching me do this stuff and watching us do this stuff. And it'll just start to make sense later on. I mean, I know you'll pick up a little bit here and then you'll pick up a little bit there, pick up a little here, there, everywhere, a little bit here, there, everywhere, right? And then eventually you kind of things start to fall into place. And you have these light bulb moments. It's like, oh, he was saying that like every time for the last 3 classes and I didn't get it. And now I get it. Oh, you get these light bulb moments. So you have to keep coming. Otherwise, you don't have those light bulb moments. So keep coming to class. Don't worry that you haven't got it. Don't worry. It's not a big deal. You'll get it. All right. So if you come in here and look, I'm going to show you. We're going to come into the calls. And the market's currently trading right at 137, right? You can see that on the software. It's got a yellow line through there. That's where the market's currently trading. So if it's in the money, it's down here, right? It's below. And if it's out of the money, it's above. It's up here. All right. So those are your strike prices. Now, if you wanted to buy down here at the B1, which is currently 120, you have to come down to 120. We're going to come all the way down, slide down to 120. There it is right there. You can see that an option at if we even right click on it and say buy, it puts a little calculator on the screen. You can see at 120, we have an option to go long, and you can buy that if you want to. But look, it's $1,797. So it's a lot more expensive than the one that's at the money. So if you come up here, let's just drag it up there. You can see your little calculator goes up there, and you can see that it's at $567. Well, that's a big difference. That's like almost $750 difference, right? So $750 difference, then you got a problem there with the amount of money that you're paying for that premium. This one down here, $1,700. This one up here, $565. Well, you can also derive from that. You can say, well, if I would have bought it down here when it was $500 and it went up to there, I'd be up about, well, if I could have bought this one for $500 back when it was up $500 and now it's $1,700, I'd be up $1,200, right? $1,300 off of there. I could have bought it if it was at the money's generally trade about $565. If I could have bought that one for $565 and it's now $1,700, you can kind of derive how much money you would have made. But that's the in the money. That's the intrinsic value, how much money it's made between where you would have bought it back here and where it's currently trading. That's called the intrinsic value. Now, there's also an additional value in here. All right. And that's because we still have 24 days left until expiration. So if we have 24 days left until expiration, you have the time value. How much time is left? Time is opportunity, right? So time is money. And this never makes more sense than right now, when we're trading options. Time is money, truly, because you have to pay for time. So the value of this option being $1,787 not only has the intrinsic value, it also has the time value. So how much do you have to pay in time? So if there's no intrinsic value, which this one does have intrinsic value, right? It's got the difference between where the current price is versus where we bought it. If we bring this up to the exact price, there's no intrinsic value. We just took all the intrinsic value out of the option, yet the option still costs $575. So why does it cost $575 if there's no intrinsic value? Well, because you have time value. All right. So there's 24 days in this case. 24 days is the time value. If you want to, you can come down here and you can calculate it and you can say, well, that's $75 per day. See that? It's in this column right here on the software. If I can bring it up, got to remove that one, got to bring this one up. Okay, so it's $75 right there. See that column right there, premium per day? It's roughly $75 per day is the time value. Now, it's on a little bit of a curve. It's not perfectly straight like that, just 75 every day, but that's the rough value. That's dividing it equally among your days. So you got 24 days divided by $1,825 gives you $76 a day. So that's your 120. If we go to the actual at the money, it's $24 a day. See that? So this is why you have intrinsic value and extrinsic value. The value of the stock or the value of the option has extrinsic value and intrinsic value. Intrinsic value, just the amount of money it's made from where you got in to where it's currently trading. Extrinsic value is the time, how much time you have left. All right. And time is money, so time costs money. All right. So now we can go back. All right. What is delta? Delta, and the reason we don't want to talk about delta is because delta is where we come in and we start talking about, this is where we get into the bull call spread with a naked leg. All right. So delta is a measure of an option's sensitivity to change in the price of the underlying asset. How much it moves up and down based on the movement of the underlying stock. And that's very important. A lot of people will trade stocks and they don't look at the chart. They look at these little funny charts that have the little graph charts in them like that, and they're neat. I mean, they're cute, they're cute, but they're worthless, basically. Not totally worthless. I mean, they're just not a lot of value. But they are cute. I mean, they're cute. All right. So what we do is we like to look at the chart. We're technical analysts, right? We know what an A1 is. We know what a B1 is. We know what a B2 is, and we know what that means. It's the probability of the market rising in price or falling in price, and what that probability is based on where the market's at in that count. And so when we look at delta to us is a probability statement. Okay. So we want to work with delta as probabilities. And that's what's really cool about looking at the chart and trading options on a chart as opposed to trading options on those little graphs. Those little graphs are just financial. They're just, what are they? They're kind of a waste of time. But besides a waste of time, they're kind of a model of what the value of the option can do in a delta scale. All right. So that's where their value is. It shows you where the highest point of delta is on those little scales of where you're going to make the most money at a certain level, right, at a certain time. But it doesn't have anything to do with the underlying chart. It just has to do with the delta scale of the underlying stock, which is why we oftentimes talk about the delta cone of probability. So if you come down here, and let me show you the delta cone of probability, we'll pop into that right here. So if you look at my delta cone of probability, see that where I drew that? Now I took the delta cone of probability and I turned it sideways, because that's how I want you to think about it. All right. Because the delta cone of probability is what those little charts are that you're seeing when you look at those little options graphs. Take those little option graphs, throw them out the window, because they don't really help you a whole lot. What you want to do is you want to be mindful of the underlying stock itself. And you want to always remember that the delta cone of probability, or the high point of the delta cone of probability, of that little chart graph, right? The little thing that you see on your screen, and everybody's trading off of them, which is totally worthless because it doesn't tell you where the market's going to go. It just tells you where the highest point of probability is. Well, we always know that the actual peak of the delta cone of probability is at the current market price. You can see it in your delta scale down here. So if you come down to your screen, you can see right here, delta is generally always 50, right around 50 at the money. So there's your 50 right there. See that on delta? No, you can't see it. I got to bring it up here. I hate the software. Okay, so we come in here and you bring it up, and you can see right here on the software, see how it says a delta of 50? Now I know I don't understand this. I don't even know why I'm watching this. I'm going to go watch YouTube videos somewhere else. This is too complicated for me. It's not complicated. I'm trying to make it simple for you. The idea is to throw those little complicated things out and just remember that the delta is always a delta scale that is right there on your chart, and that the 50% or the highest point of that little chart, that little graph, is always at the money. Where the market is currently trading is always delta 50. All right. So the market always curves off from delta 50 no matter where the price is. So up or down. All right. Up or down. And so that's why I take that little delta scale, the little chart that goes like this, and I turn it sideways. And I set it on there. And I want you to think about it like this. Okay. So the market's coming along like this. That's your exact high delta point. All right. So delta is always 0.50. And on the options, delta will get smaller as it goes up, and it will get bigger as it goes down. Why does delta increase as it goes down? Well, because it's got intrinsic value, right? And why does it go smaller when it goes up? Well, because it's only got extrinsic value or time value. That's all that's up there. There's no intrinsic value. Therefore, delta gets smaller. Now, we know from doing our analysis, right, that the one standard deviation is always right there at the peak. So 1 standard deviation, 2 standard deviations, 3 standard deviations away from the current market price. I know this is all going, whoa, Len, how is this going to help me? It's not. Forget it. Just come in here and do this stuff. All right. So that's how this all works. That's how you understand why the value of an option premium goes up and why it goes down, and why it's more expensive when it's in the market, and why it's less expensive when it's not in the money. And that's really all you really need to remember. Okay. If you buy a call option and the market goes up, you generally make money. Not always, because time value can erode faster than the market can rise. That's one of the problems with options, right? Is that if the market doesn't rise fast enough, time value can erode faster than the intrinsic value can outpace time value. That's the biggest problem. You can be right with buying a call option and the market go up and you can still lose money. Happens all the time, because people will buy options when they're very expensive, because again, the implied volatility, markets moving up and down a lot, can increase the value of the option. The option will get very expensive if the market goes up and down, because people don't know what the market's going to do. So lots of volatility causes the market to go up. We call that implied volatility. And again, that's on your chart right here. Go away, bring that up. It's right here. So this is your implied volatility. All right. So that's a scale on here too. And if that gets really high, price, you're going to notice the higher this number here, then the more expensive options get. Okay. So to put on a bull call spread, we want to make sure that we put it on the timing. This is all comes down to timing. When do I want to put on this bull call spread? And why do I want to put on a bull call spread anyway, Lan? Well, maybe you don't. You know, a lot of people just like to buy options. Just buy a call. That's all you have to do. Just buy a call. And if you think the market goes up faster than time can decay, you'll make money. And that's all there is to it. Why would I put on a bull call spread then? To collect additional premium, because you don't think the market's going to go up really super high. B1s are good places to put on bull call spreads. B1s, B2s. B3s, probably not so much. Maybe. I mean, possibly, but probably not. We're not going to put on B3s are probably not a good place, because that's where the market's going to make just one last push, and then it's going to probably flush. And so you need it to stay up there. All right. It needs a little Viagra. It can't go up and flush. It's got to go up and stay. All right. It's got to stay up there until it hits expiration. And if it doesn't stay up there and hit expiration, that's where you lose money. Because if it flushes back down, well, yeah, you make a little bit on your bull call spread, but that's not the point of a bull call spread. Bull call spread is to make money on the long call and then to also make some additional money from the premium that you sold on the sold call. What is a bull call spread? Let's go put one on. Not here. This is not a good place to put on a bull call spread. Let's go find one that is. This might be a good place to put on a bull call spread. The market's coming down. Let's put one on right here. So how do you do it? Well, let's put it on as without options first. What? How could you put on a bull call spread without options? Put it on with orders. It's basically the same concept. All right. So if we just come in here and we say that we're going to, this is my demo account, right? Yep. Okay. So we're going to come in here and we're just going to buy a call, which is buy the market. Let's do 100 shares. Can we do 100 shares? That's $34,000. Do we have $34,000? We do. All right. We're going to do it with 100 shares because that's what it means. But you don't have to pay the full $34,000 if you're going to use options. All right. That's the leverage. So we're going to buy 100 shares, which is what an option represents, 100 shares. If we're going to do it with orders, it's going to be $34,000. So let's go ahead and kick that in there. We're going to buy. Is it going to let me do it? Uh-oh. Are you guys still with me? This whole thing's all froze up again. Oh, there it went. I don't know what's going on here. Okay, we're in with the $34,000. All right, we put $34,000 in, and now we're going to take a limit order, and we're going to put the limit order up here to take profits. Maybe if it comes up here and tests this previous high. All right, there you go. That's a bull call spread. Only it's done with orders instead of with orders instead of with an option. Because all it's doing is it's saying, okay, I'm going to get in right here. And if the market goes up, I'm going to take my profits right there. So I'm going to make the difference between here and here. All right. So with 100 shares, that'd be $5,429. That's a bull call spread. Now, you can't really do the naked leg. You can kind of simulate it, I guess. It would be another limit order down here, but I don't think they're going to let us do it. We're going to leave the naked leg off for right now. But that's a bull call spread using orders. That's not complicated, right? You guys all understand that? Pretty simple, easy stuff. Bull call spread is you're just going to buy into the market, and then you're going to put a limit order to take profits off at a certain level. Now, the great thing about using orders instead of options is that if it goes up there and stays up there, and it goes up and hits that number, it's going to take your profits off. You're going to make your money, $5,400, all right, on your 100 shares. If you do it with an option, it's a little bit more complicated. You got more moving parts. So let's come in here. We're going to delete this, and we're going to exit this chart. Okay, we're going to exit out. Are we in this chart anyway? I don't think we're in this chart anyway. All right, so we're going to exit out of this chart. Come on. How come I'm not able to trade like this? Why is it so slow? Market's not closed. Look, it's not even moving. Is the market closed today again? We tried to do this. We had Juneteenth and we were on holiday, but now I can't get this to execute. Close position. Close position. This will close your position. Okay, well, do it then. All right, there it goes. All right, so now we're going to put on a bull call spread. So we're going to come in, we're going to go to positions, not positions, options, and we're going to say, how far out do we want? What's our premium time? How much time do we want? We're going to go in to 24 days, and we're going to buy a call option. All right. So we're going to buy it right at the money. Again, we talked about this, at the money, in the money, out of the money, right? So at the money is a $2,000 for 24 days. That's how much it costs. And that's all time value right now. There's no intrinsic value. All right. All time values. We're going to buy that. And we put it on there, and it comes up and it goes into our little calculator. When you hit buy down here, it doesn't actually send the order off to the exchange. It just puts a little calculator on the screen. So we got the little calculator on the screen. You can see it's $2,105 to buy this option. Now we're going to do another. We're going to sell it at the same time. We're going to put our limit order out there at the same time, right? So we're going to come over and we're going to come in and we're going to sell a call. So we're going to buy a call and we're going to sell a call. And we're going to sell the call up a little higher. So we're just going to right click on here and we're going to sell one. And we're going to slide that up. Where do we want to sell it? We'll sell it up here. And the higher you put it, the more money you can make on the long call, but the less money you make on the one you're selling. All right. So you're going to sell this, but it's like a limit order. Remember, you're going to collect more on this one, but you're going to make less on this one if it goes up there. So if this thing goes up, it can't make money any higher than above the red line because it's like a limit order. It's like taking your profits off, right? But you're getting paid to put a limit order in there. You're getting paid $415. The question is, do you think it will go higher than $415 above that red line? If you do, then you shouldn't do it. All right. But you want it to close above that red line. You want it to hit the purple line above the red line. That's max profit. If it goes way up here, well, you get your max profit, but you sacrificed everything from here to here. You don't get anything above that. But that would be the same if you put a limit order up there too, right? I mean, if you buy 100 shares and then you put a limit order up there and it goes up and takes your profit off, takes your orders off, well, you don't make anything above your limit order. That's all selling a call is up there. You're selling a limit order. I mean, you're putting a limit order in there to limit your growth, right? That's why we call them limit orders. Well, it limits the amount of money you make above that line. So this is doing the same thing. The difference is that you're paying $2,000 for this, not $37,000, and you're going to receive $415 for putting that order up there and limiting your growth potential. All right. So if this market rises in price, the max amount of money you can make is the premium between the green line and the red line. All right. That's what that's telling you. And the reason we're doing it is because we're smart. We're looking at the Fibonacci ruler. We're anticipating reversal at this level. We want to see this market rise in price. It doesn't mean it has to. We know it can go down to 61.8 and it can even go down farther. So your timing needs to be good. Now, the thing about options is you don't want to put one of these on once it makes the first green candle to make a new high. Why? Because then your premium drops way down, or it goes way up, actually, is what happened. It goes whoop, and then you have to pay a whole lot of money for an option. As if the market's going down, you don't have to pay as much money for it for a long call. But if the market's going up, you have to pay a lot of money for a long call. So as the market's coming down, it's kind of like catching a falling knife, right? But you get paid for trying to catch a falling knife in options. So that's why those little graphs that you look at are kind of worthless. They don't tell you what the underlying market's doing. They don't give you any idea or clue about what the probabilities are of the market rising in price during the next time. You have to do that yourself. You have to look at the markets. And that's why I say those little graphs, they're cute, right? They're cute. I got one. There's one. Cute. Oh, how cute. Little charts. They look so cute. Everybody likes the little cute charts, but they're basically worthless. They just tell you that this is all they're telling you. They're telling you when, where the delta cone of probability is and what the 1, 2, 3 standard deviations are. But if you don't correlate that with the underlying stock, it's not the one standard deviation of the stock market, of the stock you're buying. It's the one standard deviation of the options price, which is worthless. Who cares about the one standard deviation of the options price? We want to know what the one standard deviation is of the underlying stock, so we know whether the market's going to rise or fall based on our strategy, and then we use the strategy that's going to make money on based on that. This doesn't tell you whether you're going to lose money. It just tells you the probabilities of where the market's going to be, right? So remove this, bring this back. Okay. So we want to put on a bull call spread. There it is. So they're going to it's going to cost $2,105, and we're going to receive $415 from the option that we sold, but they're also going to limit our growth if the market rises above that before the purple line. Anything above the purple line, we don't get. That's not our money because we put a limit order, right? That's what that call option up there is a limit order. But they're going to pay you $415 to do that. All right, so that's your bull call spread. Now let's put on the naked leg. What's the naked leg? Well, it's to help us reduce the cost of this one here. Now, we're pretty confident that that market's going to go up, and we're pretty confident that market's going to go up. It's down here in the Fibonacci sweet spot. Could it go down farther? Yeah, it could. You could wait if you wanted to and see if it's going to come down to 61.8, but it's bouncing off of the 50% right now. So we're going to say, all right, we're not going to wait for the first green candle because that would make our premium go way up higher. So we're going to try and catch a falling knife. We may be wrong. The max amount of money we could lose on the premium is the premium we pay for it, $2,130. All right, that's the max amount of money we could lose. Not that we want to lose $2,130. That's a lot of money, but it is the max amount we can lose, right? That's our earnest money. So we think this market's going to go up from here. So we're going to put on a bull call spread. Now, if we thought it was going to go explosively up and go way up here, we would not want to put on a bull call spread. We just want to buy the call option. But if we think that it's going to just kind of meander a little bit up in here like this, then we put on a bull call spread. We make more money because we get to make the money between the red line and the green line plus the 420. All right. So we get that little 420 bonus, and that's why you do it. You put that on there to get that little $420 bonus. Now, if you push it out there farther, you say, well, I think maybe it might go higher. Well, okay, you're taking a gamble, right? The gamble is that you think this market's going to go close above the red line, and you're going to make more money between the green and the red line, but you're going to make less money on the bull call spread on the limit order. You're going to only make $240 now. So if you pull this closer, you make less money on the call, more money on the bull call spread. Well, Lamb, I'm happy with $1,000. Okay, we'll put $1,000 in there. That's about right there. $1,150. Now all the market has to do is just rise. You get the difference between the green and the red line, and you got a real high probability of getting your $1,000. But if the market goes above there, that's $6,000 that you're giving up, right? So that's the game you're playing. You're like, okay, well, I want to kind of play the happy medium. Okay, well, you try and figure out where you think that market's going to go. That's why I use Fibonacci projections, right? Fibonacci projections. So if the market is like this, and this is where it went in the last time we used that Fibonacci projection, we say, well, we think we got a pretty good chance based on Fibonacci that it's going to be at that purple line right up in here somewhere. That's where you'd want to kind of maximize your profit potential by making that swag, that scientific wild ass guess that we think the market's going to be at 130.9 by that purple line, or 161.9, even if you think it's going to be up here at 240, the purple line. I don't know if it'll be all the way up there. 100's where it was off that last move. It moved 100, it pulled down. If it moved another 100, it would be right here, and that'd be far below the purple line. You could just take your profits off right there. You don't have to wait for it to hit the purple line. But we're going to put this up here. Maybe we'll put it up here. I like that 130. That's 420. All right. And we're going to put that in there. And that's where we're going to put our bull call spread based on our Fibonacci projections. And we're going to do everything the best we can, right, to try and make our best guess where we think that market's going to go before that purple line within the next 24 days. Now, the naked leg. The naked leg, if we come in here, what we're going to do is we're going to sell a put. Now, we've all been following along. Those of you who have been here, you've been doing naked puts with me, right? You've been doing what we call cash secured puts, which means we just sell a put, and then if the market comes down there, we buy the shares at that level. We're assigned the shares, and that's good. We got the shares. Now, this is the same thing. All we're going to do is going to add this to this bull call spread. That's our naked leg. A naked leg is just an unsecured put, right? Cash secured put. You got to have the cash in the account to buy the shares. So you can't do a naked leg if you don't have that cash. It's just a cash secured put. That's all it is. So we're going to add a cash secured put to a bull call spread. Now, where are you going to put it? Well, you can put it right here at 61.8. And if the market came down, you get assigned your shares at that level. And they're going to give you $355 for that. And they're going to actually apply that $355 towards your 209, and it'll reduce the amount of money, the outlay that you're going to have to pay, right? So if we drop that in there right there, you can see your little calculator didn't define it for some reason. There we go. So now you can see that we brought it in there. So they're going to give us $605 against our 2,095 long, and they're going to give us $420 against the 2,000. So now we take 600 and add that to 420 and subtract that from 295. And you can see your little calculator over here. And I'm going to try and make this a little bigger so you can see it. You can see our little calculator over here. We're going to only have to pay $1,000 for this position, not $36,000 like we had to pay if we were going to do it with 100 shares. All right. See the difference? That's your leverage. That's your leverage. So what's the max profit on this thing? Well, it's going to be the difference between here. So the green line to the red line. If it closes above the red line, right? It's got to close above the red line to get that money. It's got to hit the purple line above the red line. Then you're going to get $5,872 off of your long call. and you're going to get $420 off of your sold put or sold call, and you're going to get $605 off of your sold put. So you're going to get 605 plus 420 plus 5,872. That would be max profit. And that's only if the market hits the purple line above the red line. That's how much money you would make. All right. And what's the outlay? $1,000. That's not bad money. Okay. You'd make $5,872 on the long call if it closes above the red line, hits the purple line above the red line. Now, if it hits down here, it's not going to make as much money, right? So I'm just giving you max profit. Max profit is if those little snaky thing, right? It's a carnival game. The carnival game is if the little snaky thing hits the purple line above the red line, you're going to get 5,872. Plus, you're going to get 425 from your sold call. Plus, you're going to get $600 from your sold put. That's a bull call spread with a naked leg, and it's going to cost you $1,000 to put on. What's max loss, Lan? Okay, you got two of them going because you got a naked leg. So think about them individually. First of all, you could lose the entire premium of your call option. That's $2,175, and that's if the market just kept going down. All right, if it goes down here, let's say it hits the purple line underneath this red line, what's going to happen? Well, we're going to lose $2,175. We're going to make $425. So that, it's like putting a little methylate. Remember methylate on your wound, right? It's going to sting like hell, but it's going to take away just a little bit of the sting, a little bit of the hurt. Methylate, is that what we used to call it? It's that red stuff you'd put on your wound. You cut yourself and you put some methylate on there. All right, it's going to sting. Yeah, it's going to sting because you're going to lose $2,175. But this is the medicine. They're going to still give you $425. And you're going to be like, okay, at least I get $425. And they're going to give you the $600. Oh, so you mean I'm really only going to lose $1,000? That's right. You're going to lose $1,000. But because you got the naked leg, it's a naked leg. That means anything underneath there is also going to be a loss. So if it closes, let's say it hits right here underneath there, you're going to also lose down to as much as, because this market here's uncovered, it's cash secured, means you can lose everything underneath it. So it can lose right there. That would be $2,300 that you would lose. But they're not going to really, it's a paper loss because they're going to assign you the shares, right? And your shares are going to be down $2,300. And so then you have the shares, the 100 shares, and then the shares can turn and go back up and make money if they don't go down and lose more money. All right, so they're going to assign you the shares. You're going to get 100 shares. You're going to get taken out of your bull call spread. You're going to lose $1,000 on your bull call spread and whatever loss on the naked leg. That's if the market just keeps coming down and hits that purple line. So you got to look at both. You can't just look at the rosy side and say, oh, I gotta make all kinds of money. You got to look at the loss side too. All right. Now, you can take this bull call spread. And why am I going so deep into this bull call spread? Why am I spending so much time on this? The reason I'm spending so much time to help you understand the bull call spread is because we love the yield max funds, right? We like yield max. This is their strategy. This is what they're doing. All right. But what they do is they take this leg, this naked leg down here, and they don't put it down here for $600. They put it right on top of that green line, right on top of the long call. So they bring it up right there. Boom. Holy schmorlies. What did that just do? Well, if you're going to put that naked leg right on top of your long call, look at the cost now. There is no cost. We're going to receive $240. Why? Because the sold put is the exact same strike price, so it's the same cost, right? It's the same amount of money as the long call. So when you put that on top of each other, that's called a free trade. You got the long call, and you've also got the premium coming in from the short put, which is going to pay for the long call. So that zeroes out, becomes zero. And then you sell your premium up here, you sell your call option, and you get, in this case, $425. And it looks like there's a bit of a skew in the difference between the put and the call of about $200. So we're going to actually, by putting this on, we're going to actually receive $240. Does that make sense? you're going to receive $240 by putting this on. You're like, wait a second. I'm going to actually, it's a free trade. They're going to give me $240 to put this on. And if the market rises above that red line, I'm going to get $5,872. They're going to give me money, and I'm going to make money if the market rises. What? I received $240 and I'm going to make money if the market rises? Yes. What happens if the market goes down? It's the same as if you bought the long position with the 100 shares. You have the same risk if the market goes down you would as if you just owned the shares for the next 24 days. Now, YieldMax doesn't necessarily do it just like this. They do what we call laddering, where they put these in at different price times. So they're going to anticipate. Now, I've always said YieldMax is a fund that if the market doesn't go up, everybody loses. Right? Everybody loses if you have a long position and the market goes down, everybody loses, even YieldMax. They lose less because they've got a covered call, meaning they're going to pick up that $425, where if you just did it with shares, you would not pick up the $425. That's how they can pay you a dividend even when they lost money. All right, so they lost money, but they still get that $425, which goes into the coffers. They kick out a dividend, and if they need to kick out $1,000, but they only made $425, they're going to give you what we call ROCC, right? Return of cash and capital. They're going to say, well, the reason Land has a position in YieldMax is because he's calculated that he needs about $1,000 a month to live off of. Well, we only made $425 this month. So we're going to give him the $425. That's the cash. And then we're also going to give him roughly $500 of his own money back. That's the capital, so that he has that $1,000 that he can live off of. That's what YieldMax is designed for. All these people that are out there going, oh, it's a yield trap. It's a yield trap. They don't understand the concept. They're just dumb people. Don't worry about it. There's dumb people out here too, pretending like they know what they're talking about. They don't. They don't understand what YieldMax was designed for. It's designed to give people income. All right? It's for income people. Now, if the market's going up, and it only goes up, which markets rarely do, right? They don't only go up. If the market would just go up, well, YieldMax would make money hand over fist. They would never have to give you any of your own capital back so that you can pay your bills. But if you need to pay your bills and you're trading, this is the thing that people don't understand about YieldMax. If you're trading for income, which many people don't trade for income. Did you know that? They don't take the income. Why? Because they want one great big pot of gold at the end of the rainbow. They're looking for one great big pot of gold at the end of the rainbow. And if that's the case, well, great, bully for them. Hopefully it's there. If you're in a YieldMax fund, you're taking profits along the way. So you take a little bit of money out every month. If you're taking money out of your account every month, YieldMax is going to, if the market's rising, well, you don't have to take any of your own capital out. Why? Because you're making enough money to cover your expenses. But if the market doesn't go up far enough, well, you have to take some of your previous profits out, or even maybe some of the money you put in. Let's say you put in $500,000, $300,000, $200,000, and your account hasn't ever made anything above $300,000, but you need to live off of it anyway. Well, I got bills to pay. I'm living off my income. Well, what are you going to do? The only choice you have is to take some of that money you put in. If you put $300,000 in, well, you're going to have to take some of that $300,000 back out so you can pay your bills. That's not a bad thing. It's the way, if you're going to make money, you're going to put it into the stock market and then live off of it. You got to take it back out and spend it on your bills. People, it's such a hard concept to understand that sometimes you're going to take money out of the stock market. So all these people who keep saying, well, YieldMax is a yield trap. Oh, don't do that. Oh, they're dumb people. They don't understand that you got to take money out. Because if you had shares in there, or if you had just a bunch of money sitting in there and you needed to pay a bill, you're going to take your money out, right? That's taking money out of the market. It's just that YieldMax does it for you systematically, as opposed to you going in there and manually having to say, well, I'm going to take money out. And you take money out. Well, now you have less shares. You have less shares. Is that a yield trap? If you want to live off the shares that you have in there and you take some out, oh no, it's a yield trap. Don't take money out. If you sell some shares, it's a yield trap. Bullshit. It's not a yield trap. It's just the stupidest thing. It's the stupidest argument. It's just people who don't know what they're. It's just young guys that don't know. Well, I've seen old guys that have been doing this for 30 years calling it a yield trap. It's just people who don't understand the concept of taking money out of the stock market. All right. Oh, it's a yield trap. You take money out. Whether you take it out, whether you got shares, whether you take money out of the market, it's going to make your account value back. You got to live off of it. That's the whole idea. That's the whole damn idea. All right. Sorry, going off on stupid people in the stock market, teaching people the wrong thing. It's just frustrating for me as an educator, somebody who's been doing this for 40 years, and then to come in and watch all these people who have much bigger voices than me. I have a little tiny voice. I mean, I'm just a little school teacher from a quiet little university in southern Utah. I don't have a big voice. And then I see these people who have big voices out here on some of these great big firms, great big websites saying this stupid stuff. I'm like, dude, you should not have your own. You're so dumb. You should not have a voice as big as you do. It's just because they're naive. I don't want to call them dumb. It's just an area of the market that they have no knowledge in, and they're trying to speak about it as if they do, and they don't. And there's things I don't know about certain areas of the market, and I try to make comments on it sometimes, and I'm sure some guy comes along and says, that guy doesn't know what he's talking about, because we all have our specialties. But anyway, I'm just trying to teach you what YieldMax does, and that's how the system works. All right. And so if the market goes down and they want to still give you some money so you can pay your bills, they're going to pull money out of the account. And yes, that's called it's not a yield trap. It's just a deduction in the yield in the amount of money that you have available for reinvesting because you spent it. But that would happen even on a normal market, even if you were just trading without being in the YieldMax funds and you take money out. It's degradation of your account, however you want to call it, whatever you want to call it. Taking money out makes your account go down. I know. What a weird concept. Okay, here we go. Let's go in. That's a bull call spread with the naked leg, and that's how YieldMax does it. And they do layering. All right, they do layering so that if the market does keep going down, they can keep covering themselves, keep making money on the way down. They're not making as much as they're not making as much as they're losing, but they're still making money because the bull call spread, the sold call is making money. All right, they're collecting the $425. Now, if it keeps going down, they will lose money more slowly than any other market. Another market that has shares will lose 100% of the delta. If you do it like this, you don't lose 100% of the delta until you get to a point where expiration, but you also collect the premium. So you can still apply the premium towards the cost of the loss. So you're losing money more slowly. So when the stock market goes down, let's say you invest in Tesla and Tesla goes down, well, you're going to lose money, right? I mean, everybody agrees if you put money into Tesla and Tesla goes down, you're going to lose money. It's the same thing here because that option right there, that synthetic long position, that's what they call that. It's a synthetic long position. Is going to act exactly like shares. Therefore, if the market goes down, it's going to lose the same amount as if it had the shares. But you also have the call option, which is collecting premium. So Tesla, you have 100 shares. Tesla, you have 100 shares. The market goes down, you lose the same amount of money, right? Because it's a synthetic long. But because you're in the YieldMax fund, they also collect the 425. So now because they collected the 425, they actually lost less money than the Tesla fund. Now we're going to take money out because I have to pay my bills. I have a house payment. I need food. I need gas for my car. Unless I have a Tesla, then I need electricity for my car. But I have bills I have to pay, right? So you take money out. If you take money out of Tesla when it's down, it's yield degradation the same as it is if you take it out of YieldMax. It's the exact same thing. People just stop with this bullshit. I just don't understand why people who have such big voices and supposed to have so much knowledge can't understand the concept of it's the same damn thing. All right. Yes, when it goes up, you don't make as much money because you're capped at your profit. We understand that, and we're willing to sacrifice a little bit of the upside potential for the monthly systematic income and the protection on the downside. That's what you're sacrificing. Yes, if you are in an explosive market and Tesla takes off and goes to the moon, well, you might not catch that top little piece. Okay, because you put a limit order in there to take profits at a certain level, and if the market just kept going, well, you didn't capture it. But remember, yield max, they do what they call laddering. So they might not catch it on this one, but they catch it on this one. And they might not catch it on that one, but they catch it on that one. So because they ladder, they can also capture all those gains. And that's why sometimes you get great big dividends and sometimes you get little tiny dividends. It's not rocket science, people. All right, that's my rant and rave again. You guys have heard that rant a million times, but I can't make some people listen. They don't listen to me. I'm just got a tiny little voice from a university in southern Utah. All right, so here's some opportunities. Here's some different markets. Let's come. What's going on now? There we go. So Meta. Look at that. Meta's breaking. This is a B1 right here. Do we want to put on a bull call spread? Now, the thing that you have to realize is that you don't have to put on the bull call spread immediately. You could say, hey, Meta might be going right here. I think, I want to buy into Meta right here. So we can come down here and we can say, well, I want to do 115 days, right, for the longer position. All right, well, let's do that. Let's come in here and we're going to just do them one leg at a time just so we can kind of see what's going on. We're going to come in here 115 days. Let's go look at the volume on that. Let's go 115, 150, 150s. 115. I like that 100-day time frame. 87 days. Not good. Let's go back to the 115. So we're going to put on a 115 call. All right. We're going to drop that in there at the money. It's $5,600. And we can just say, well, we think the market's going to go up, right? Well, it's a B1. If we want to, we can come in here. Let's just put that on. We can just go in there and buy the call. Maybe. See if it'll let us do it. Oh, not buy it. It's already there. So we just have to place the order. Let's go. It doesn't like market orders. Let's put in a limit order. They're asking 56.25. We're at 56.08. Let's go up to 56.25. We'll just give them what they want because that's what a market order would be anyway. 56.25. I put a couple of dollars above just to try and get them placed. All right. I don't understand why it takes so long. I don't know why it sits there and waits forever. Come on. Come on. Pending. I don't know why it just sits there and waits forever. I can't demonstrate if I can't get the damn thing to. It's just a long call at the money, guys. Come on. Fill the damn thing. I haven't got very good. I got 393. I should be doing this one probably down here. Let's see if it'll let me cancel it. Won't let me fill it. Cancel? Well, that's gone. Let's go buy this one. It's a little bit more money, but we got more volume and open interest. Did that one? 61.95. 61.95. Place order. Come on, fill me. All right, I can't get the orders to fill. We're in a demo account. It won't fill. I don't know why. All right. So let's do this. Let's come in and we're going to cancel this order. We'll go and I'll show you what I was going to do. We'll just put them in there without order placing them. All right. I was going to come in. I was going to go buy a call at the money, and then I was going to sell a put at the money. Show you. That's a free trade. Just if we do those two, look, they're going to receive $185 just by putting those two on there. And that's exactly the same as buying the shares. That's basically the same as buying the shares. And I'm actually receiving $185 because there's a put, there's a call put skew. Not really 185 because I'm going to lose it in the commission here. Commission, the spread is 50. I don't know. That might be calculated into it. But that's going to have a margin requirement of $22,000, which is basically the same as buying the shares, right? So that's what YieldMax does. They come in here and they do this. But then they come in here and then they sell the call up here and they collect, in this case, $2,000. Well, there you go. Now you're receiving $2,200. What if the market goes down? Well, it's the same as if you had the shares of the market went down, but you still get the $2,000. That's it. You just have to be smart about whether you think the market's going to go up or down. Now, these guys are continually laddering them in there, and they're layering them in there because they just need to, they're just constantly trading and layering them in. They're not like you and me who are just going to do one or two at a time. So you got to be more strategic about it. They're more systematic about it. All right. And they'll just constantly be putting them on. They got a great big bucket of money because why? Because you gave them a whole bunch of money. That's what YieldMax, that's what, you know, if you're doing Tesla and you have Tesla, well, TSLY is nothing more than a bucket of money that's being used to put on these synthetic longs. All right. You need to have the margin. Okay. Look at this. Let's get rid of this. Another lesson. All right. So we're going to go in here and we're going to buy the call and we're going to sell the call. All right. Or sell the put. Right. At the exact same strike price. Now you see here, we're going to pay, in this case, we're going to pay $320. So the situation is we are now the exact same thing as a 100 shares long, right? And the market's going to go up and down, and we're going to make or lose the exact same as if we were 100 shares long. But look how much the margin is. The margin requirement is $22,000. Well, where does that $22,000 come from? It comes from the TSLY account. Now, if I put this on, do I actually put $22,000 into Tesla? Answer me that. Think about it. I have a bucket of money, which is my cash account. See my cash account up in here? Here, my cash account right here. See that? If I put this on, does it actually take the money out of my cash account? No, it doesn't. It's still there. It's just locked. I can't get to it. That's my margin amount. That's why I have an account value and I have a buying power. I have two things, two numbers, right? I have a number which is my account value and I have my buying power. So you'll see that my account value is $132,000, but my buying power is only $88,000. Now, if I could get that order to place, if I hit the button and place it and it actually placed it, it would take my buying power down by $22,000. Wouldn't take my money down, just take my buying power down. My account value would remain the same. And I wouldn't be putting the money in as if I had bought shares. That money is still there in my cash account. Well, when you put your money into Tesla or into Tesla, TSLY, they're not actually taking the money out to put it into Tesla. They are using it as their buying power. That TSLY account is their buying power, how much buying power they have to put on synthetic long positions in TSLA, in Tesla. So that's why TSLY, that's why we don't pay much attention to the price of TSLY, because we're really more focused on TSLA. Now, is the market going to go up or down? Because if it's going to go up, well, our buying power from TSLY will increase or decrease based on how much money we're making, both on the synthetic long versus how much we're collecting on the covered call. Now, we don't have our covered call on here. Does that make sense? Hopefully you guys understand that. And that's what's going on. And I know it seems a little complicated at first, but if you get your head into it, it makes so much sense. It's just like, oh my gosh, these guys are brilliant. And then you got these idiots out here with these big voices. Oh, it's a yield trap. It's a yield trap. They're naive. I don't want to call them stupid because they're probably very brilliant people, but they're naive in this area. All right. They're probably not options traders. That's That's the biggest thing that I found. People who don't understand options, they think they do. Oh yeah, buy call. But they have no idea what a synthetic long is. They have no idea what a cash secured put is. They don't understand the concepts of them. All right, because they've been taught their whole life to look at this. They've been taught their whole life, oh, it's a little graph, this little graph, but they have no idea or no conceptual understanding of how an option increases or decreases in value based on the underlying stock itself. On the actual movement of the stock is what increases or decreases the value of the option, and by how much, and what that all is and how that all works. So they just don't know. They're just naive. They've been stuck with, they've never been taught the real way an option works. They've kind of in this academic world and they don't understand it. They don't understand the nuts and bolts of it. What you're going to find is most of these guys actually don't trade. That's what you really find. These guys are all analysts and they write all these articles and stuff, but they don't actually trade. So they might put their money into the S&P 500 or put it into a few, ETFs that might have a little bit of a dividend, and then they think they're smart, but they don't understand the whole concept of the markets. They don't really dissect them, and they don't understand all of the intricate parts of what all this stuff means. You talk to them, you start to find that out. Anyway, if they say that, there you go. That's your if they say yield max is a yield trap, there you go. They don't know what they're talking about. They don't know the intricacies. They probably don't trade themselves. There you go. That's your test right there. I do too trade. Okay, I believe you. All right. So what do we need to do now? That's a lesson on bull call spreads. I'm having a hard time getting them filled. I don't know if it's because of the internet and because when I'm not on YouTube, it seems like I can fill these orders just fine. I'm sure you guys are able to fill them. I'm just having a problem with, I don't know why. Whenever I'm on this YouTube thing, I can't get option orders to fill. And I don't know. We'll see. Anyway, that's the lesson on bull call spreads. I've pontificated long enough. Let's go in and update my UBI portfolio, and then we'll be done for the class for today. So do we need this? I'll leave it up just in case. Let's pull up my UBI portfolio. All right, here we go. This is real money. All right, this is my real money account. I figure we just pull this up. Now this isn't, here, let's get that off. Those are just models. That's not real money. People look at that and they're all, oh, just don't pay attention to the man behind the curtain. Those are not real. Those are just placeholders. All right, so let's come in. This is real. This is all real money. All right, everything you see in here is real money. This over here, that's not real money. That's just mathematical placeholders. Uh-oh. How come that's way over there? Mount Till. Oh, I think that was something I was testing. Okay, here we go. So let's go through and look at my portfolio last night. I'm going to bring my little account over here so I can see it. All right, let's update. I have to go in and look at my notifications because I got notifications that tell me. And we'll start off with Palantir. Actually, Palantir is the one. Yeah, let's start off with Palantir. See how much money I made in Palantir. Today's not been a bad day. I guess my account's up about $9,000 today. So can't complain about that. All right. So is that Palantir? Okay, Palantir. Come on, Lan. I'm trying to hurry, and then I make it go slower. All right, here we go. So it says, let's go to Palantir. Palantir is this first box right here. All right, so that's my Palantir box. You can see over here, these are just statistics up here. But then down here, these are how much money I put into Palantir, and this is the dividends they paid out of Palantir. And you can see that I'm $34,000 above parity. Now, parity isn't profit. Parity is just the difference between the number of dividends they've given me versus the money I've put in. That's not profit. It's just because I will continue to make profit in the future, which will make parity go up. All right, I'll continue to receive dividends. And if I keep putting more money into Palantir, it will give me more money in the future, but that will make my parity go down. Okay. So parity is not profit. Parity is just the difference between the dividends I've received and the amount of money I've put in. So that's where we come up here and we calculate a cash cow or a gravy train. All right. So it is now a cash cow because I'm not sure if that's right. I'm going to have to recalculate. I was telling you the other day, I was rethinking my cash cow and gravy train calculations, but I think I got it right for the whole account. Now I have to go see if I've got it right for the individuals. I might have done this right. I think I might be. I don't know. I got to double check. I was thinking about it the other night and I was thinking, I think I got an error in my cash cow account on my individuals. So I'm going to check that, but I don't think that's right. So don't look at that number right there. I don't think it's right. This is right. The parity is correct. But today is June, April 5, 23. So today is June 24th. So we got 06/20. It came in yesterday, 23-2025. So it came in exactly on the day 1 month later. And this time, look, last month I made $12,669. That was my dividend. This month I only got $7,269.42. So I only made, why is that not a dollar sign? Come on, land. Those are all dollar signs. Let's see, dollar signs. There we go. Okay, so you can see now I put a big bunch of money in June. Oh, $20,000 in June. Oh, I don't know if that should have paid out. Anyway, total infusion, I got $141,000 in Palantir. Last month, it paid $12,600 in dividends. That's because that market just went straight up. It was beautiful. So I got 3,000 or 6,000 in January, March, 8,000 in April, I mean. June was 12,600. Crazy. And then I got 7,000 this month. So I'm total premiums that I've received so far, total dividends has been $35,000 against my total infusion of $141,000. All right. The current value of the account is $147 because you got to take that into consideration too. But to get to be a cash cow, this has to be equal this. I have to have $141,000 in dividends to be a cash cow. Now, if I have, and then I'll be on the gravy train. So the gravy train, I'm calculating. Oh, that's what I've been doing. My initial investment is $5,200. That's why that's at 24. Because I've been playing with the idea. You got blended money, and I've talked a little bit about blended money. So blended money is when you don't know whether the money that you're reinvesting is part of your initial investment or if it's part of the dividends, because they get blended together. Eventually, you can't separate them. You never know which is which, right? But this, I'm trying to say anything in 2024 was infusion, and anything after that was blended. So that's why I've got 2024 broken out here, and then here you can see that I've got blended or dividend reinvestments. So these I'm counting all as dividend reinvestments. Anything in 2024, I'm going to count as initial investment. All right, so I got initial investment up here at $476,600. You can get this spreadsheet. I've given you this spreadsheet. It's, if you're a subscriber to Pitt News Magazine, you get this spreadsheet in your email every month when you get your notification of the new version of Pitt News Magazine, which is going to drop here at the end of this week. First of next week we get the new Pitt News Magazine, but you can get this spreadsheet, and I've updated it like I've updated it like 6 times this month because I keep reevaluating how I'm calculating cash cow, because it goes off of the UBI versus the total dividends and the blended money thing. So I'm trying to figure that all out. So I've updated the spreadsheet, and you can get that when you subscribe to Pitt News Magazine. What? Subscribe to Pitt News Magazine? Or what are you talking about? I don't even know anything about Pitt News Magazine. Whoa, let Claire tell you about Pitt News Magazine then.
Hey, Claire here. Guess what? Mr. Turner handed me the mic. I've now got my very own podcast. Pitt News on Air, your new weekly hit from Pitt News Magazine. Join me every Wednesday.
That's not what I wanted to have you talk about, Claire. She's talking about her podcast. I want you to learn about the magazine. Here, let's do this one. This is the magazine.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com. Pitt News Magazine. News your way.
All right, that's where you get Pitt News. All right, so if you want Pitt News Magazine, you can go over there, and then you get this spreadsheet along with it. Okay, so now we're going to do, so that is Palantir. So what's my next one? My next one is NVIDIA. So we got to do NVIDIA. Let's come down here, NVIDIA, and we're going to add in here 606 23 2024. And I got, how much did I get in NVIDIA? In this account, 1971.81. Okay. I've got 5 accounts that have Yield Max funds in them. So why is that not working? What happened to that? All those should be dollars. So that was a $1,900. Look at that, almost exactly the same as April, $1,975. Last time I put money into NVIDIA was back here in March. So my parity right now, look at that. That brings my parity up to 399, up positive. So I was below parity, but now I'm above parity. Okay. So that's parity. That 1,971 is what I got out of this one. How many shares do you have, Lan? I have 2,933 shares at an average cost of $21. It's currently trading at $16, a difference of $5.49. Okay, so 1,971, and that's automatic. Should be automatically putting up here. So Palantir and NVIDIA automatically went here and here. So you can see this month is completely filled out. No, it's not. You still got more land. You still got more money coming in. So we got NVIDIA. That's for the other account. YMAG for this account. Okay, let's go do YMAG. Because right now it's sitting at $30,000 this month that I've made. Last month I made $53,000, and the month before that I made $30,000. So I'm already at $30,000. I matched April, and I've still got more dividends to go. 2 more, YMAG and YMAX. They're not very big, but they are money. You got to count them. I get to count every little penny. Okay, so let's go down. The next one, that is NVIDIA. That's the other account. I got $1,000 in my other NVIDIA account yesterday too. And Palantir, I got $2,000 in my Palantir in my other account too. So I got 7, 8, 9. So I got $9,000 in Palantir this month because of my 2 accounts. Actually, that's just what came in here. I've still got I don't think I have any. Oh, I have Palantir in a third account too, which I know was over $1,000. I have a lot of Palantir in all my accounts. I like Palantir. Not exactly fond of what they do for a living, though. They do human surveillance with AI for the military. I guess. I don't know. Yes. Okay. Hopefully they don't infringe on our. I don't know. I'm not going to get into the politics of it. All right. YMAG. So YMAG for this account, okay, is 502.63. So YMAG is down here, and it's part of June. So I'm just going to add it in right here. Oh, look, that's only got 2. I'm going to go check. I think I got more than that. I don't think that's correct. I think I've missed one. So YMAG. I know you guys are looking at me saying, you have a really extensive spreadsheet here, Lan. I know, but this is what we're working on. We're working on a program that's going to make it so we don't need this spreadsheet. I know, I've been saying that for the last year, but it's vaporware at this point. We'll get it. Don't worry about it. It's coming. Then you won't need to have these big spreadsheets. It'll all be done for you in a nice little program. It's a little software program that does all this stuff for you. You're going to be so happy. Okay, so I actually started at 6:20 on June 6, 6/20/92. Then I went to, oh no, that's all I got. June 6th, and then I got 5:07. Oh, and then 5:02.63. 5:02.63, which means I'll get another one this Friday. That's why. So that's the 3, and I'll get 4 because I get one every Friday. 5:02.63. So that brought that up to 1,600 so far, and I'll probably get another one about the same size, about another $100, another $500 to that one there on this coming Friday. All right, so that's correct. All right, let's go see what my next one is. That was YMAG. Okay, and then for YMAG, I got more money in my other account. I got $677 in the other account. Okay, for this account, YMAX, I got a tiny amount. I don't have a lot of money in here, 23,000. So in here, we're going to add the next one in, which is only plus how much? YMAX dividend paid, I got 179.47. So I got so far $623. If I add another 200 bucks to that, 7, 8, I'll be around $800 here. So it'll be more than in April, more than in March, but probably close to what I got in February. Okay, so I'm not going to complain. Not going to complain. All right, that's all I got for this one. We could go over and do the demo account one, but we're running out of time today. That's all I got for this one. So you can see up here, I started with 476,000. I got 237,000 totally invested. My total infusion is 830,000. Total gains, get out of the way, you stupid thing. Hide until reopen. Okay. Total gains reinvested, 354,000. Blended income deposit, that's 116,000. Get out of there. Stocks and options currently, I'm up 21,000 on this account. And then cash withdrawals, I've taken out $93,000. And cash on hand, I have 7,000. Not anymore. I have more than that because they've given me all this money. So now I have to put in my cash on hand. It's not invested yet. That's got to be changed to $16,923.35. All right. So I got 16,000 cash on hand. I never drip, never do automatically reinvest back into the same fund that just gave me money. The reason I don't do that is because every single penny that comes out to me, I decide when new infusion goes back in where it goes based on A1, A2, A3, B1, B2, B3, C1, C2, C3. I go through and every single time I get a dividend, it goes into cash, and then I decide where and when it gets put back into the market, whether it goes into another yield max fund, or whether it goes into a fund that's just one of the pairs of a yield max fund, or whether I just go buy some options. Like right now, I got $21,000 in options. So in this account, and I got 10 accounts. So this one account is all, never drip your money. Never, ever, ever. Never, ever. That's the number one sin. All right. All right. Cash on hand, trading account value, trading account current total value. And so my profit and loss for this since July, because that's when we started this, since July is $288,000. So July comes up next month. I'm going to run this account all the way until December. You can see I got it set up to go all the way till December. So it's going to be a year and a half on this particular account. Then I'm going to take this spreadsheet and I'm going to create the second spreadsheet. That way I'll have a clean start. I'll know what my balance is. Whatever my balance is, I take it up as my initial deposit. And then I will start to 2026 with a whole new fresh setup. And every single thing, even though it's all blended money now, I will count it as not blended money starting 2026. I'm going to say that's now my initial deposit. and then we'll move forward through 2026, and it'll be a lot cleaner mathematical model. I won't be having to do blend. Hopefully by then, though, I won't have to do the spreadsheet because we'll have our software ready. But anyway, that's the idea. All right. So if you don't want the software, you just want to do your spreadsheet, that's how you'll be doing it. So I'm currently up $288,000 since last July. That's not bad. I'm not going to complain about that, considering that we had that big flush in the market. And I was learning, I was doing a lot of stupid stuff in the first 6 months where, I was buying and selling because I was learning about YieldMax too. It's brand new. So I was doing all the stupid stuff that the other guys were talking about. But now I figured it all out. We're all copacetic. I understand what's going on. I'm up $288,000 for the year. I mean, you could basically say for the year, because I started this in July and we're almost, we're a week away from July. So I can't complain about that. In this one account, I've made 288,000. Now, I think I've made about 100 and something thousand, let's say a little over 100,000 in my other account. So actually I'm up 380, let's say just rounded to 300 and almost $400,000 this year. Not quite. Well, because I got like 3 other accounts too. So yeah, I broke 400,000. I don't think I've made 500,000 this year, but I've made 400,000. Easily broke 400,000 this year trading. That's not bad. You can't complain about that, right? So under parity, I'm $39,000. That says, over parity because it's green. So I'm $40,000 over parity. And return on investment on this account is 61%. So that's pretty good. Now, I know guys are way more than that. I know there's people out there made 100% on their accounts or 200% on their account, and they're just like superheroes. And I know. But I'm happy with 61%. I'm happy with that. I'm very happy with 61% return. It's better than I can get at Cash Valley Bank in a bank CD. Now, yes, I got a much higher risk, but I got a much higher return. So that's the name of the game, guys. That's how we're doing it. And we're doing it primarily in this account. Well, this account is at this point 100% yield max. This is my yield max account. Some of my other accounts have no yield max in them at all. I got accounts that are just strictly options trading. I still do lots of options trading. I love it. Don't want to give it up yet, but I'm looking at this and saying, I don't know why the hell I'm doing it myself. I could just let these guys do it for me. And, yeah, it is what it is. All right, guys, that's it.
Okay, this is the software I use. It's called Track and Trade. They've got 2 versions, one for stocks, one for futures. This is the website, track, the letter N, trade.com. This is where you download a free 2-week trial. No credit card required. Okay, go download your copy, then come back here, follow along, and I'll show you all my settings.
All right, that's it. That's all I got for you today. I'm going to let you go. Hopefully you learned something, a little bit about my pontificating about the bull call spread with the naked leg, which is basically what these guys are doing and how they're doing it for me. So I just let them run those bull call spreads with naked legs, and I just reap the benefits. It's that easy. You just got to understand it so that it doesn't, scare you and make you think you're in a yield trap. You just got to understand the concept. Once you understand the concept, you can deal with it. All right. You know how it's working, and you can either reinvest or you can take the profits. So it's up to you. I've done pretty good with it. You can't complain. A $476,000 investment. I made $288,000 or 61% return on investment, almost exclusive. I can't say exclusively because there's $21,000 coming in from some options that I bought here in this market. So, and some shares. So not exclusively yield max in this fund, but that's a little bit more realistic when you got something other than just yield max. All right, guys, I'm going to let you go. We're going to catch you tomorrow afternoon for a little bit of fun in the afternoon, do a little day trading. All right. We'll see you then. Take care.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pitt News Magazine.
Oh yeah, definitely subscribe to Pitt News Magazine. You'll thank us later.